Hey everybody, I'm Christopher Green. You're tuning into AMTV Alternative Media Television. Please click the link below to support our sponsor. Check out and join the Outsider Club provided by Angel Publishing. They provide excellent reports, everything covering the economy, what to expect with rising inflation, how to manage these very uncertain economic times in our future. Click that link, subscribe to the free newsletter, the Outsider Club, and check out their website right now. So what do I think is going to happen going forward? I mean, what is my economic outlook coming into 2014 and approaching 2015? Well, I think we're going to get more of the same. Now, when we're taking a real objective look at the markets itself today, they're trading at all-time record highs. They are literally in the stratosphere. I mean, this is unbelievable. This was a gravy train on Wall Street last year. The Dow Jones Industrial Average, I believe, had its best year in 18 years. And the S&P 500, its best year, I believe, in 16 years. So this is an absolute throw a large party. This is kind of like the Leonardo DiCaprio movie where he's snorting coke. I haven't seen it, but this is what I've heard. He's snorting coke and, screwing hookers. I mean, this is as good as it gets, courtesy of bailouts, Ben Bernanke, Helicopter Ben, 0% interest rates into infinity. Where I think we have a fundamental change this year, and I believe that interest rates will be on the rise in 2014. Now, of course, it's kind of like the equivalent of being on the ground floor in the basement. Because the Fed funds rate is at 0 and lending is at 0%, although real interest rates are actually negative. That's how low they are. Once you're already at the ground floor in the basement, there's only one way to go, and that's up. You can't go any lower. You've already dug yourself a deep enough hole. So the only way rates and only direction rates can go is higher. Now, what will that do? Now, I don't even think we need a material change in interest rates for it to put material pressure, not just on U.S. equities, but the housing market itself. The 10-year, for example, could rise a percentage point, maybe rise 2 percentage points, and it could really have catastrophic consequences for the system and the market itself today. Now, of course, you compare times in history like the 1970s where Americans were looking at treasury bonds, maybe paying 10 to 15% in some cases, and I'm only talking about a few point percentage increase up in the 10-year, to give you an example. People want to know, well, what do we do? What do we do in a situation where interest rates are rising? This is putting pressure, kneecapping the market. We could very likely have another market crash like what we experienced in 2008 or in 1929 based on history, of course. And this is important to know. The market is always its riskiest when people don't think there's any risk. And that's exactly where we are today. Nobody thinks there's any risk. Everybody thinks the Federal Reserve has it under control. That somehow a crystal ball of bailouts to infinity just, landed us back into Americanville, where we're going to dominate the world, even though that hasn't translated into the real economy. So when we look at viable, realistic solutions for the average Joe, John and Jane, people like me, people like you tuning in, what is it that you can do to keep up with rising inflation, which is a very severe threat, and I believe it'll be the greatest threat in 2014 and going forward? And what do you do in an environment where the dollar is devaluing, where the U.S. dollar is in a devaluation phase, which is what inflation is? It's what people don't really understand fundamentally as a fundamental concept, as I ranted about yesterday. Well, some common things, and let me preface, I'm no longer a financial advisor, although that was my background for 10 years. I was in the finance field. I can't give you financial advice. I'm just giving you my opinion. So take it for what it is, and please consult a professional based on your individual situation before making investment decisions of your own. But this is my opinion. In a rising interest rate environment, a traditional financial advisor would tell you, well, buy the stock market. That keeps up with inflation. But as we just discussed, there's extreme risk in the market. Now, that doesn't mean that the stock market can't rise another 2,000 points. It could even go higher than that. We could very likely be looking at Dow 18,000, and then poof, the crash. Problem is, you might be riding out more appreciation, but when the market actually does take a dive, it happens immediately, just like we had the flash crash, I believe it was May 2010 when I was working in the business, and the Dow Jones Industrial Average dropped 1,000 points, literally in seconds. Imagine if that happened again, and let's say the Dow dropped 5,000 points in seconds. That's a possibility. So it's very difficult for the little guy to know when to get out. It is an option, but it's a risky option. More conservative options are bond laddering. Some of you may be familiar with this. Some of you may not. Let me give you an example. You can buy bonds and ladder them to participate in a rising interest rate environment. So let's say you buy a 5-year bond and a 10-year bond and then a 15-year bond. So you have 3 bonds. Each time each new bond matures, when that 5-year bond matures, you roll it over into another bond participating in those higher interest rates and in higher yields. That's a very effective strategy, whether or not you're laddering CDs or you're laddering corporate bonds or municipal securities. That's a very real, tangible solution to participating in an inflationary environment. And also my favorite, and which I think should be a part of every well-diversified, balanced portfolio, is real assets, are tangible goods. Things like gold and silver. And let me point out gold for a moment because it's been selling off a little bit over the past few weeks, even the past few months, which to me is a gift, which to me is a buying opportunity. You know, many of you who've been buying gold for years, you know, really should be looking at this as another opportunity to dollar cost average, to lower your cost basis in the metal itself. Now remember, they banned, outlawed, and made gold illegal after 1929 in the early 1930s. It was an executive order signed into law. I want you to think about that for a minute. The federal government at the time in the 30s, coming off the Great Depression, didn't want you to own gold. That tells you something about how valuable gold and precious metals really are. And the reason they cited is they didn't want people to hold real wealth at the time. And they didn't want people to hoard real tangible wealth. They still wanted them to, and wanted the people at the time that were suffering during the Great Depression, they wanted them to participate in the Ponzi scheme that is the Federal Reserve and the U.S. dollar, which is backed by nothing. So gold and precious metals are both very viable options in an inflationary environment. Now, real estate, although in certain parts of the country, places like Phoenix that have literally done this, and then right here in 2008 and just had a little beep, you know, it's not really a recovery, but people were kind of, I guess, excited about it. When interest rates rise, that makes the cost of carrying a home or a mortgage or any credit investments itself, any loans more expensive. It should put more pressure on home prices. But real estate is still a tangible asset that you can hold. And at the very least, at least you have a roof over your head. So real estate, it's another area you should diversify your portfolio. Other areas, thinking outside of the box. I personally love art. I love, all kinds of art. And it's a great thing to own because you can also enjoy it. It's something tangible, it's something real, and it's something that does appreciate in value. So you can look at things like that and other collectibles that are real. And that's what you should be focusing on in this environment, folks, is things that are real, things that are tangible, things that you can hold or puts a roof over your head that you can participate in, even in a worst case scenario. Food. Other people will say food. Food. Land. Farmland, another excellent investment, participating in commodities. All of these things are excellent ways to build your portfolio, build your wealth long term, protect you and your family's assets, and grow into the future in any environment, no matter how bad things get here in the United States, no matter how bad the U.S. dollar crashes. Now, of course, there's negatives to holding physical gold, bullion, silver, precious metals, arts, collectibles, jewelry, those kinds of things, because, of course, you have to buy insurance, you actually have to store it. It's not what we would call traditionally liquid, but there's also major advantages in an economy and in a world and at a time in history when things are extremely uncertain. And of course this all leads to war, and I believe humbly that we are already engaged in the next global confrontation. We are already engaged in the new war. Most people just don't recognize it. Just like it took decades for the American people and the American government and the mainstream media to admit that we were fighting the war in Vietnam at the time, I believe we're going through much of the same history today with the next great war here in the United States, which is a global confrontation focused on the reserve currency, which happens to be the dollar at this very point in history. Hopefully you found this video useful. Some of the ideas mention applicable to your given situation. Again, please consult a professional and look at some of these viable options and alternatives to protecting you and your family. I'm Christopher Green. You've been watching AMTV Alternative Media Television. As always, hard-hitting and in your face. Please get this video out everywhere. Click the link below to support our sponsor and make it viral.